Hey everyone, and welcome to The Explainer. Today, we're doing something I find absolutely fascinating. We are going to mechanically decode one of the most wild financial periods in modern history. We're talking about the massive wealth creation and the extreme headline-driven volatility of the U.S. stock market, spanning all the way from the 2017 term straight through to where we are right now in 2026. Look, whether you're a portfolio manager, a CFO, or just someone who really wants to understand the actual plumbing of how policies impact asset prices, you are definitely in the right place. We're stripping away the politics entirely today and looking purely at the data, the financial engineering, and the deep market mechanics of this era. Let's get into it.
Okay, let's dive into this. To really grasp this era, there's a foundational concept we have to nail down first. This entire market environment was defined by a massive, distinct dichotomy. You had incredibly aggressive pro-business domestic policies, think massive tax cuts and heavy deregulation, colliding head-on with heterodox, totally unpredictable foreign policies, specifically the weaponization of global trade tariffs. And this unique combination? It completely overrode traditional historical models. Usually, markets follow fairly predictable four-year election cycles. But here, executive policy actively used market disruption as a negotiating tactic, creating a completely unprecedented paradigm for investors to navigate. Just to impartially establish exactly how powerful the domestic side of that equation was, let's check the scoreboard. 81.3%. That was the staggering total return of the S&P 500 during that first term, from January 2017 to January 2021. I mean, this wasn't just a good run. That ranks as the fourth highest investor return over a four-year presidential term since 1980. Even with a global pandemic and intense trade wars thrown into the mix, the underlying structural changes to corporate earnings provided an incredibly resilient floor for equity valuations.
But, as you probably remember, that massive growth definitely did not happen in a straight line. Right alongside that historic wealth creation, we saw moments of sheer, absolute panic. That sudden drop correlates directly with this number, 55. That was the staggering peak of the VIX, the market's literal fear gauge, during the sudden April 2025 tariff shock. Just to put that into perspective for a second, a VIX of 55 is a level of market terror we hadn't seen since the darkest days of the COVID-19 lockdowns. And really, this is the core tension of our entire narrative today. How do you actually manage a portfolio that hits historic, record-breaking highs, but is also uniquely susceptible to violent, multi-trillion-dollar drawdowns triggered by literally a single policy announcement?
Moving on to Section 1, the foundation, taxes, buybacks, and deregulation. To figure out how we got here, we really need to look at the mechanical financial engineering that built this market floor.
So, the single most consequential domestic policy for equities during this entire era was hands down the 2017 Tax Cuts and Jobs Act. By permanently dropping the peak corporate tax rate from 35% down to 21% and throwing in a steep discount for multinational corporations to bring cash back from overseas, this legislation just fundamentally altered corporate income statements overnight. Think about it mechanically. Before companies sold a single extra widget or innovated a new product, their net earnings just automatically shot up. On average, this added a massive $1.80 per share to the net earnings of S&P 500 firms, and the market, being a forward-looking discounting mechanism, rapidly expanded its valuation multiples to price in this huge new wave of permanent profitability.
And this brilliantly illustrates what corporations actually did with that massive windfall. Now, proponents argued the tax cuts would trigger a huge renaissance in physical factories, capital expenditures, and R&D. But the data tells a totally different story. A massive 80% of that repatriated and saved capital went straight into financial engineering, specifically share buybacks, dividends, and M&A. Only about 20% actually went to CapEx and R&D. You see, when a company buys back its own stock, it physically reduces the outstanding float of shares on the open market. So that higher net income is now distributed across way fewer shares, which rapidly and mechanically inflates earnings per share. This whole buyback frenzy basically wove a foundational safety net right under stock prices.
But here is a really crucial takeaway. Macroeconomic forces completely overrode political rhetoric. The administration heavily championed America First energy independence, right? They aggressively deregulated fossil fuels. So naturally, you'd think energy stocks would be the undisputed winners. But look at this. They actually contracted by 9% during that first term, basically crippled by a massive global supply glut and pandemic demand destruction. Meanwhile, information technology, which was riding these huge secular tailwinds of cloud computing and digital transformation, absolutely soared, returning 114%. It's a stark reminder that while policy might set the stage, global macro trends are the ones actually writing the script. We also absolutely have to talk about the financial sector here, because deregulation didn't just stop in the first term. Moving into the 2025-2026 term, the administration actively pushed back against the international Basel III endgame capital requirements. By stalling those really strict banking resiliency standards, the top 13 U.S. banks effectively unlocked a staggering $200 billion in excess capital. I mean, for a bank, $200 billion is pure, unadulterated dry powder. It's a massive green light to aggressively push loan growth, launch even more share buybacks, and completely finance a resurgence in Wall Street deal-making.
Let's move to Section 2 and see how this builds. We're looking at the stress test, tariffs and market volatility. If taxes built the floor, the weaponization of global trade tariffs absolutely stress-tested the ceiling.
See, when the administration deployed sweeping tariffs on imported goods, the stated goal was to force companies to onshore production. But that runs smack into a really rigid economic reality called trade elasticity. Basically, this is the speed at which an economy can actually substitute imported goods for domestic ones. Our sources note that during the 2018-2019 trade war, it took 4 full years for this elasticity measure to tick up from 1 to 4. And if you've ever managed a supply chain, you know this intimately. You just can't adapt overnight. Because they couldn't instantly find cheaper domestic suppliers, U.S. corporations had to absorb those massive tariff costs themselves. This deeply crushed forward-looking margin estimates and triggered some intense market sell-offs.
And that reality created a crazy, highly predictable pattern of panic and relief. Let's walk through this timeline from the spring of 2025. In early April, the administration announced severe Liberation Day reciprocal tariffs globally. By mid-April, the market goes into full panic mode. The S&P 500 plunges 12.1%, and the VIX spikes over 55, an absolutely terrifying environment for equity holders. But then, using market disruption as a negotiating tactic, the administration suddenly announces a 90-day delay on April 9th. The relief was instantaneous. By late April, the market experienced a massive, totally explosive 9.5% single-day relief rally, literally the best single day since 2008. It was this perfectly mechanical sequence, executive-induced distress, followed immediately by engineered monumental relief. Now, while everyday retail investors saw those violent swings as totally terrifying, savvy institutional traders, they looked at this and saw an incredibly lucrative new asset class. Enter the Vega effect. Institutional option writers realized that these sudden VIX spikes mathematically inflated the premiums of options contracts. Basically, insurance on the market became incredibly expensive, and because these headline-driven panics almost always ended in a policy delay or reversal, these traders systematically sold those overvalued options right at the peak of the panic. When the implied volatility predictably collapsed a few days later, they harvested massive profits. They quite literally transformed executive branch unpredictability into a highly tradable strategy. All right, Section 3, the 2026 landscape. AI frenzy meets macro reality. Let's shift our explainer over to where we sit right now in mid-May 2026, with the S&P 500 trading at these rarefied all-time highs above 7,400. Now, what's really interesting about this slide is the intense tug-of-war we are watching play out in real time. On one side, you have the phenomenal AI hypercycle. And it's not just tech hardware giants like NVIDIA pushing towards a $6 trillion valuation. The AI software narrative is actually repricing legacy companies too. I mean, automakers like Ford are surging 21% in days as investors apply tech multiples to old-school manufacturing. But this unstoppable AI boom is acting as a massive macroeconomic stabilizer against the very persistent headwinds you see on the right. The administration's tariffs and domestic policies have created the sticky inflation, which has trapped the 10-year Treasury yield at a really elevated 4.59%. And that high cost of capital is a constant threat, just trying to drain liquidity away from the equity markets.
To make things even more complex, we've got an intense internal fiscal battle happening. Back in July 2025, the One Big Beautiful Bill permanently extended tax cuts and injected a mind-boggling $4.5 trillion into the economy. But simultaneously, to fight the inflationary pressures of those very cuts and to address a really dangerous $1.8 trillion deficit, we now have the Department of Government Efficiency, or DOGE, led by Elon Musk. They are aggressively trying to audit and slash the federal spending that was exacerbated by those same tax cuts. So we're basically watching a massive, real-time economic experiment, trying to balance brand new fiscal stimulus against severe federal restraint.
Bring this to Section 4, the playbook. Strategies for the modern investor. Let's tie all of this together with some actual actionable takeaways for CFOs, portfolio managers, and focused learners analyzing the back half of 2026.
So the crucial point is that this high beta environment heavily rewards agility and it severely punishes complacency. Let's rapid fire through these. Geographic diversification is absolutely your first line of defense. Aim for roughly 30% outside the US to hedge against localized tariff inflation. Next, don't fear the volatility. Embrace it. Utilize structured products and define downside notes that let you harvest those inflated option premiums we just talked about. You also want to lean into active sector rotation. Overweight the clear winners of deregulation like financials, while dodging tariff-sensitive sectors like materials. And finally, for the corporate operators out there, supply chain redundancy is non-negotiable right now, especially building buffers around critical rare earth minerals, which are basically ground zero for global trade friction.
Which brings us to the defining dilemma of the modern market. As we look at the rest of 2026 and beyond, here's the question every single investor and business leader has to ask themselves. How will you balance the unstoppable, wealth-generating momentum of technological innovation against the highly unpredictable, heavy gravity of protectionist economic policy? It is an incredibly precarious equilibrium, but understanding the actual mechanics we've decoded today is absolutely your best defense. Thank you so much for hanging out and learning with me on this explainer. Keep curious, stay agile out there, and I will catch you all next time.